Big hedge funds now only have 72 hours to report major losses and margin calls. We're going to get into this situation, how today with Fed Jerome Powell, as well as what we've seen recently with AMC stock, could be helping to fuel some of these new proposed rule changes. There you can see good old Gary Gensler. It's been a while since we talked about him coming on the scene and shaking things up. So it looks like someone somewhere is hurting. Let's get into exactly what is going on. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. Now, if this is what I think it is, and basically goes to show that there are major losses that are starting to accumulate out there, well, the odds of getting margin calls is dramatically increased. Now, with this new proposed, well, it's not even proposed, it's literally been passed here today as of about an hour ago. What this is going to do is take away some of that control from hedge funds. Hedge funds, they have a lot of capital, right? Most of the time. Even your small hedge funds have hundreds of millions of dollars most of the time, right? Or assets that they can use to collateralize and to remain in short positions. Now, what this is going to do, and why I think this is actually very significant, is when hedge funds start to face some pretty big losses, there's going to be the SEC and other regulatory authorities that make the decision for these hedge funds, or at least influence their decisions quite dramatically, right? And if they have to report these losses just within 72 hours, then there's not going to be a lot of time for them to manage some of these losses, right? And these losses can be pretty large, not only with just stocks that are currently going through short squeezes, but even when you factor in cost to borrow fees. Now, obviously, these rule changes are going into effect because of what happened in 2021 and Archegos and all these losses we've seen from hedge funds in specific names. But even if you look at AMC and something that has happened recently, where hedge funds in mark-to-market losses on equity value alone have lost about $500 million, give or take, in AMC stock in 2023 so far. But they've also lost about $2 billion in just Q1 on the cost to borrow fees alone. So all in all, they're taking massive losses, and a lot of people thought this was a home run trade, so they're leveraged up to the neck in this trade. Now, if AMC goes through this rally that I think is about to happen, the decision might be made for hedge funds whether to cover or not. Meaning that if they start to take some very big losses, and even if the hedge fund wants to remain in that position and they don't want to realize that loss, they might be forced to realize that loss to cover on short positions. And the way that I see AMC right now is very much primed for a big upside break from here. If you look at this purely on a technical basis, we have not been technically this bullish since back here. Since back here in July of 2022. This is the most similar technical picture to what I can see happening right now. The charts almost look the same. Besides, you have this wick down here, this hammer pattern, or this hammer candlestick that started this rally that we've seen recently. Back here, you didn't really see that, but back here, you just got a big candle, and then you kind of just melted higher, seeing consistently green days, or even on the red days were not that big. Now, what happened back here? The stock went from a low of $7.60 per share all the way up to a high of about $17 per share. There was that eventual pop-off rally. Now, the rally actually happened right after earnings. It kicked into, full steam ahead the day after earnings was a 19% rally. And that is what helped definitely bring the stock up, higher. And if you look at where AMC is at now, I mean, earnings are on Friday. It's a similar pattern than what we have seen. Now back here, AMC stock did sell off before earnings, quite big, about 3% negative, 9% negative, 4% negative, and then another 6% negative day before you did start to go through this rally. So even now, heading into earnings, AMC looks more bullish than you even seen back then. And again, that was right before earnings. Or you could point this time out, right? Where AMC kind of just strung together a bunch of green days in a row and then finally seen that pop off top kind of rally. And that sent the stock from a low of about $8 per share to a high of about $21 per share. And I think if this rule was implemented during these times where the stock was, going up 100, 200, 300% in value in just the course of, 2 weeks or so, sometimes less than that, sometimes a week, well, they would be forced to cover on their short positions, right? I don't think they're going to have as much of a choice to say, hey, we'll just put up more collateral. We'll see how this thing goes over the next week or two, and we're not going to cover right now. We're just going to ride it out. We're going to ride through the pain. Well, that might no longer be a thing anymore. And now you're hitting the highest levels that you have seen since March 14th. And now you're well above March 14th levels with the data here. Keep this in mind. I think a lot of people forget this. The data behind AMC is at the best squeezable moments than you have seen throughout this whole entire trade. The short interest is at a record high. You thought the rallies, that we've seen so far have been aggressive with AMC. You thought the rally in January or June was impressive, where the stock 10x in value. Short interest is about 4% higher now than it was then. I mean, I think that's pretty clear that everyone's piling into short positions in a trade that is obviously not going the way that they would like it to. And they're losing hundreds of percents every quarter. The max gain on this trade is like 150%. So most of these hedge funds are down either way you put it on this trade that they made. That's literally a fact, right? So for those reasons here, I think it sucks to be a short right now. I think the decision is really going to be taken from them. Now, the headline here actually says, quote, large hedge funds will have just 3 days to privately tell U.S. regulators about extraordinarily investment losses and major margin events under a new rule from the Securities and Exchange Commission. Margin rules. Now, why is this happening at a time when the margin debt is actually falling by quite a bit? You're at the lowest margin debt levels in quite a while. I mean, you went higher from February to March by about, $20 billion. But overall, this same time last year, in March of 2022, margin debt was $753 billion. Now it's $645 billion. Now, I think the margin obviously is a little bit less spread out this time around. I think a lot more people had margin, last year in 2021, like retail investors, hedge funds, everyone was using it. Now I think a lot of retail investors, as the data would suggest, have been getting out of margin, where institutional investors are a lot more reluctant to get out of that margin. So I think it's a little bit more concentrated where the margin actually is within portfolios in the stock market. It's not as much in retail investors' portfolios now as it is in hedge fund portfolios. And if you think about it, the stocks that did well during 2021 and 2022, I mean, if you had margin in those stocks, you've lost your money. You've seen margin calls already. Like, it's already happened. It's not a thing that's going to happen. It's happened. Now, hedge funds, they really have not seen the full effect of those margin calls. Now, if we go ahead and take a look at the data, just so everyone knows where we currently are, let's just put this into context, right? The estimated short interest of free float is sitting at about 25.5%. Over the last 18 months, this is the highest level that you have been at since the rally of June of 2021 as well. Short interest was only ever about 23%. You're over 2.2% higher than that, and you were just almost at 27%. So the shorts are there. Like, that's obvious. It's at the highest levels it's been at. So you're very much prone to getting a short squeeze. At the same time, days to cover, while it's not at a record high, it's pretty close to it. You're sitting at about 5 days to cover. The record high we've seen over the last 18 months is about 6 days to cover. So you're pretty close to that. Pretty extreme levels here. Anything higher than this really puts the stock prone to seeing a short squeeze. Now, the dollar amount currently sold short in AMC stock, obviously this has went down since the share price of AMC has also went down, but it's all relative to the short interest of free float. Short interest dollar amount is currently at $725 million. The free float out on loan at about 34%. Like I said, days to cover at 5. The trailing 3-month cost to borrow rates are at the most extreme levels that you have seen. And hopefully you guys can see this good from where you guys are watching this video. Cost to borrow rates over the last 3 months. Let's go ahead and see if we can zoom this in a little bit. Let's see right here. So it should be a little bit easier to see now. Where you were sitting at like 1%, 5%, 20%, 10%, 50%. It wasn't until really 2023 where these cost to borrow rates started to jack up and stay up. Sometimes you've seen cost to borrow rates spike, but they wouldn't hold up. The trailing 3-month average cost to borrow rate is 238%, almost 239%. You have not seen numbers like this ever. This is actually up from 18 months ago, 19,000%. The cost to borrow fees are up. Let me repeat that. Almost 19,000% from 18 months ago. And 18 months ago was the end of 2021. So, I mean, you're dramatically higher. You've been at 100% share utilization as well since February of 2022. So it's not like there's a lot of shares that are just out there that are able to be, bought back to cover on a short position. You might have to really pay up, when push comes to shove to get out of that said short position. So I think all of this is a step in the right direction, can give you, a more explosive rally with AMC, when other people are making the decisions, when regulators are seeing those balances and they're looking at a position that has gotten absolutely wiped and it's worth a lot of money. I mean, I think it's pretty self-explanatory. That's a good thing, and that's a bullish thing. So hopefully you guys have more information on this. Hopefully we did a good enough job of elaborating on this situation. Let me know what you guys think about this down below in the comment section. Thank you guys for watching. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you guys also want to take it a step further and come trade with me live in real time, link down below in the description of this video as well. Earnings season is the best season, baby. Thank you for watching again, and I will see you in the next one.